Welcome to the first episode of Trading Discipline, folks. How you all doing? So before we jump onto the content, I have to talk about one fact. A pretty simple fact. There are just two kinds of traders in the world. The ones who are coming out profitable as a whole. Number two, everybody else. So what are we doing right here, guys? We are trying to come out profitable in the market in the long term. So if you find yourself in the second category, this video is going to be very helpful in the long-term mindset development as well. But even if you have been coming out profit in the market as a whole, maybe this could be a brief recap as to how risk management metrics work in the market as a whole. So with that said, let's jump right into it, guys. Stop losses, different kinds of stop losses. So many people have crazy amount of misconception about this simple term called stop loss. What is a stop loss? Essentially, you want to be cutting out your losses in the market when you identify that maybe the trend is going against you, or maybe the market is going into a direction that you did not anticipate. You use a stop loss for that. Three kinds of stop losses: mental stop loss, technical stop loss, and a confirmation based stop loss, guys. Now this is a little complicated, but we'll start off with mental stop loss at first. So as the word suggests, mental stop loss is something that a trader does not have to feed on his computer, guys. Essentially, you don't have to place any limit order or any stop market order, but you are going to be certain and you're going to be clear about some key levels that if the market violates some key levels, I'm going to be out of the market, right? That is called a mental stop loss. Essentially, knowing where to take an exit if train goes down south is called a mental stop loss. Being aware of key levels on any price action, on any asset, any crypto asset, any stock market asset as well. So my mental stop loss, for example, if I'm trading the extreme small time frames, let's just say I'm trying to trade the rest of this month right here, I would know, guys, that I would be looking at the weekly time frame, and if Bitcoin closes weekly candles below this entire zone, below $60,000, that would tell me that even if I don't have any technical stop loss placed in my order books, maybe I need to get out, or maybe I need to change my plans because the biases are going to change in the small to mid time frames, which is why my trading is also going to change. So in simple terms, having a stop loss without a technical stop loss in the market is called a mental stop loss. You have to be aware about key levels and key moments in the market. Now, second, we have technical stop loss. It's very simple. You go to your exchange and you place a stop market order. Well, a stop loss could be placed below this wick low right here, or a stop loss could be placed below this candle low as well. Since we are dealing with the weekly time frame, the basics of trading tells us that maybe if we take out this weekly low to the downside, that is when your trend is most likely going to be invalidated. Most likely your uptrend will go through a consolidation, guys. So this is where you would want to keep your technical stop loss, right? Now, there are crazy amount of issues with technical stop losses in the market, guys. You know the deal about crypto assets being illiquid in the market as compared to stock markets. The stop losses and the stop hunts are very, very common in our crypto assets, guys, which is why I would be putting a lot of focus into mental stop losses rather than technical stop loss as a whole, guys. So there's a myth as well in the market. A lot of people say that I don't use a stop loss. Look, everybody knows their equity management, everybody knows their risk management, and most of these people who are not using a technical stop loss will most certainly use a mental stop loss, guys, right? There has to be a stop loss, there has to be an exit point, otherwise you would be just waiting and watching for your assets to go down, right? There has to be some kind of stop loss in the market. Okay, guys, I think technical stop loss is pretty much clear right here. You place your orders below some key levels for trend invalidation or a bias invalidation, right, with the help of limit orders or stock market orders. Now up next, we have confirmation based stop losses, guys. Confirmation based stop losses do work out very, very, very nicely, especially on Bitcoin land, guys, specifically on Bitcoin land. I can give you an example right here. So what is a confirmation based stop loss? Essentially, how do you confirm a trend? Once you start opening and closing a candle above or below a key level, that is how you confirm a trend. Remember, guys, open and a closure makes a trend. At least it starts a new trend in the market. For example, let's take a look at this price action at $59,000 Bitcoin. So everybody was like, okay, our weekly candle has finally closed above $60,000. Well, we can expect some crazy continuation move to the upside, and maybe Bitcoin will simply go towards $100,000 when we were right here. But what happened in the next candle was that we did see a follow through, but the ultimate closure was below $60,000, guys. This was not a confirmation, right? Essentially, this is what confirmation means. You want to establish a trend, a new trend that can be bullish or that can be bearish, right? But if you are simply negating confirmations in the market, you would often find yourself trapped out on these levels, right? For example, if you had not posted any stop loss or any mental little stop loss, after this rejection right here coming from these levels, maybe things would have looked bad in the coming days. And if you were holding a position for, let's just say, a couple of months or something like that, things would have been a little difficult, right? I'm sure a lot of people would have been doing that, and with that, we will talk about margin management and risk management as well, guys. But before that, let me conclude the confirmation based stop loss right here. Now, what do I mean by this? Weekly trend is to the upside, guys. We are setting in higher lows as we keep on progressing to the upside. Now, the only confirmation that I am looking forward to, if I'm looking for a reversal trade in the market, or maybe if I'm looking for an exit from crypto market, that would be invalidation of this low. Essentially, if the price action starts confirming a trend, let's say, guys, a trend like this starts emerging, right? So if I see any sort of price action which is simply dripping down like this and maybe establishing a lower low as compared to this one, guys, a low which is lower than this one right here, that would mean that I have a confirmation of a trend reversal, right? And I'm going to take an exit from the market. So that's called your confirmation based stop losses, guys. Essentially, you do need a lot of patience for confirmation based stop losses because our crypto assets are very volatile, guys. So with that said, I think we are ready to jump into the next topic, guys, which is going to be equity management. I do believe that crazy amount of MBA schools and finance schools will do a way better job than I would be trying to do in this matter right here, guys, equity management. Because you know the deal. If you have been trading with crypto assets, if you have been trading in general, or if you have been buying assets or doing this for some time, you know that crazy amount of things happen across this word called equity management, right? But we're going to be bifurcating, we're going to be cutting short, and we're going to be talking about precise things, guys. Knowing your margins, understanding your collaterals, and managing your market exposure, guys. These things come under equity management. So knowing your margin. For this one right here, guys, we're going to be jumping into the Deribit testnet account right here. Now, guys, what is a margin? Margin is essentially 11.25 BTC right here. That's going to be my margin, right? And this is, let's just say, this is the amount, this is the sum that I can use as my collateral to trade in the market. So margin is equals to collateral, right? So if I talk about $700,000 being the equity level right here, I'm going to be comfortable taking a $300,000 long exposure on Bitcoin, guys. Now, this is my risk management metric, and this can be, let's just say, your risk management metric as well. Staying below your 100% margin usage, guys. I mean, essentially, if I have 11 BTC right here, I'm not going to go ahead and jump into a completely full-blown 11 BTC long position in the market. And I'm pretty much sure a lot of you are using 2x leverage, 3x leverage. That means a lot of you would be using 33 Bitcoin long exposure in the market with 11 BTC as balance. Now, if you know what you're doing in the small time frames to mid time frames, and if you know the liquidity levels, if you know the areas where if the money is going out and coming in, if you know those levels from different standpoints, maybe then things will work better in leverage as well, right? But you have to know how margin and collateral works as a whole before playing with fire, guys. Leverage is equals to playing with fire. Leverage is borrowed money. I would like to simply associate leverage with debt. So if you talk about $700,000 being my equity right here, I would be simply taking positions as per as my comfort zone, guys. For example, in this exchange account right here, 44% of my initial margin being used in the market is completely fine, guys. Now, why do I say this? Because if the asset went down and invalidated right here and cut my stop loss from the market, I mean, I would have been down 30%, guys. Had I been long on my entire equity, I would have been down 30%. My 11 BTC would have been now 8.5 something BTC like that, guys. So this is also one of those things, guys, knowing the risk as well, right? This is why knowing your margin first tells a lot of things, guys. Tells a lot of things, right? Keep these things in mind. Maybe it will work out for good. And hit that like if you've not done that. Okay, now understanding collateral, guys. Now, what is the difference between margins and collaterals? I guess there is none, right? So collateral is something that you're going to be keeping up your trading exchange to take futures positions, or maybe borrow something, or maybe lend something as well. I mean, essentially, you can do crazy amount of things with your collateral as a whole. Now, if we talk about FTX as an exchange, FTX allows you to keep Ethereum, Bitcoin, Litecoin, XRP, Synthetics Network, Chainlink, and many crypto assets as your base collateral to take long positions or short positions on futures market, right? So if you know your collateral, guys, now this is a little difficult. This is a little higher level of equity management as a whole, because our base assets are crazy volatile, right? We're talking about crypto markets, guys. We're talking about Ethereum, we're talking about Bitcoin, and all of these assets by default are volatile by 20-30% in a 24-hour cycle as a whole, which is why having different things as your collateral as you take positions in the market can certainly be difficult. But if you know what you're doing with all of these things, yes, this works out very nicely, guys. I had collateralized everything on Bitcoin, and then I was jumping into long positions on Ethereum and Chainlink with my Bitcoin collateral. I hope this makes sense to you guys. And links to FTX will be down in the description. I do feel that if you're trading, if you are just trying to be a trader in the market, guys, I think sticking to efficiency is going to be the best thing that you can possibly do for yourself. Because if you're doing this every single day, you don't want any laggy or sloppy behavior coming from the exchange itself. Am I endorsing FTX right now? I'm not doing that, guys. I'm simply not doing that. But what I can tell you for sure is that I've been using FTX for almost 3 years now, and I don't think any exchange is on par with FTX as a whole, guys. I mean, the way margin collateral and everything works on FTX is just something which is beyond capabilities of lot of crypto exchanges as a whole, guys. Which is why links to FTX will be down in the description, and I have staked a couple of FTT tokens for you guys right here so that you can go with discounted trading as well. Links will be down below, guys, for FTX, right? Okay, now the last point right here is managing your exposure, guys. Managing your exposure in the market. Let's talk about Ethereum. What do we see right here? We have 111 Ethereum, which is almost $500,000. I am exposed to a couple of naked long exposure. This is, let's just say, this is a wrecked behavior, guys. This is a simple wrecked behavior. These calls are completely uncovered, right? These calls are completely uncovered, and I do have my own technical understanding, and I do have my collateral management as a whole, which is why I'm doing this in the market, guys. Remember, if you understand your margin, if you understand your collateral, you would start formulating your risk management metrics as well. For example, we have 111 Ethereum right here, and all of these positions combined are not even 10 Ethereum, guys. Simply enough, if Ethereum is going to be invalidating some key levels, I'm going to be getting rid of my futures exposure at first, and then I'm going to be hedging my call exposure in the market with my accounts risk, overall risk being 5 to 6% as a whole, guys. 5 to 6% as a whole. And essentially, guys, I have my mental stop losses as well in place. So all of these things combined are allowing me to understand my margin, and this is how I'm able to manage it as well, right? I hope that made sense back again to you guys. Okay, guys, little difficult things to understand right here. Let me know down in the comments if you didn't understand any one of this one right here. I will try to help you out as much as I can. And with that said, I think we are ready to jump into the last topic for the day itself, which is certainly the most important, guys. Out of stop losses, equity management, the most important thing, believe it or not, risk to reward ratio is the key to success for, let's just say, crazy amount of traders in the market, guys. A systematic approach with good equity management and a well-defined risk to reward ratio is equals to success in crypto markets or any markets as a whole if you are a trader. A systematic approach towards risk and reward ratios, right? What do I mean by that, guys? Let's take a look at this on the charts. A systematic approach to risk to reward would mean patience as well. First point is going to be patience, guys. What have we seen right here? The market was in a bearish trend, guys. You can take a look at the videos from literally 18th, 19th of July. I did post a video on Ethereum and how to nail a long trade coming from the bottom, guys. When the price action was right here, and I had no idea what Ethereum is about to do. I had no idea, right? Either it could break the floor and go to the downside all the way towards these levels, or maybe it could come here and retest and get picked up and simply roll to the upside. This is what I had up my mind as a simple thesis. And how was I managing? How was I looking at the risk to reward opportunities in the market? It was pretty much simple, guys. I was waiting for areas of values to come into fruition at first. As soon as I saw that Ethereum is nearing this range with about a 5 to 6% gap in the price action, that is when I started scaling into Ethereum. And essentially, I started longing Ethereum below $1,900. And essentially, my acceptance for me getting stopped out of the market was simply below the wick low, guys, which was fortunately enough just below $1,700. So for this R&R ratio, I had a clear-cut clear-cut stop loss below $1,700, and I kept on scaling, and I was completely fine about the fact that maybe my trade could get stopped out of the market, but I'm going to jump into this trade. I'm going to be jumping into this risk-taking behavior right here, and I'm going to let the risk to reward ratio play out, guys. And my simple target was right here. That gave me an RNR of 5.71. Remember, guys, profitable traders need 1:3 RNR, right? 1:3. That's all, guys. 1:3. If you lose $1, you're making $3 in a trade. If you repeat that cycle in a systematic approach, you make money. You compound your wealth. That is how you do it, guys. There's no shortcut to it. There's no one single trade which is going to be which is going to be making you a millionaire. Holy shit. I wish I understood these things as I was jumping into these markets. But, well, let's just say it's a game of patience, and it's a game of understanding yourself first, then the market later, guys. Okay, now what happened next was pretty amusing to me as well, because we simply went straight up to the target, guys. And look, as a disciplined approach in the market, I simply got rid of my positions. This was my risk, this was my reward. I got it. That's it, guys. A systematic approach to things, right? Because if you are trading in the market will come up with infinite opportunities, right? If you're playing the hodling and investing game, probably this video is not for you. Or probably it can be for you. You can just change the time frame. You can change the time frame into monthly or maybe bi-weekly as well. But if you are trading in the market every single day, these small little building blocks is certainly going to work out in the bigger picture, guys. So this is the systematic approach towards risk to reward. By systematic, I mean that I know what losses am I going to incur if this goes down south. It's as simple as that, guys. A very systematic approach according to my equity, my stop losses level, and my own trading behavior as well. Second point, and probably one of those myths as well in the market, risk to reward is always going to be above win rate. Is always going to be above winning ratios, guys. Now, a lot of people say that I have a winning ratio which is 60%, but if their equity management is not on par with their trading as a whole, the win ratio would not matter, guys. Let's just talk about an example right here. Let's just talk about any person who has a 60% win rate, right? So essentially it means that out of 100 trades, you are winning 60 trades in the market, and then you're losing 40 trades. But essentially the size of your losses is going to be more than the winning trades that you've made in the market, which is going to be killing your overall profits, and you'll come back down below. Which is why winning rate overall does not matter, guys. This is something which I found out true for myself, as I have traded in, let's just say, in a lot of dynamics in crypto assets and equities as well. Most of the times your win rate will not matter. Remember, guys, I'm saying most of the times. For a lot of people, win rates will matter because of different equity management and different risk management as well. I'm not saying that it will not work at all. That brings me on to the last point for the day, and this particular video, the first video from Traders Discipline right here, is going to be knowing the risks before you jump into any trade, guys. I can't stress enough on this one, man. I mean, I simply cannot stress enough on this one. A lot of people, I mean, essentially, I would tell you something, you would most likely relate to this. So if you are not 100% confident, well, nobody is 100% confident, but if you're not that confident about any trade and you still jump into that trade because of, I don't know, some FOMO or something like that, what you'll do is, even if the asset goes down by 1%, you'll just simply chicken out. You'll just simply let that position go, and then you will just take that position away from the market just to watch that price action back again go into the upside. And then you'll jump back into the position, and then it'll come back down, and then you'll go out of the market, and then it'll go up back again. So why is this happening? Why is this happening again and again? Why are you doing this again and again? Look, guys, I had to do a lot of, let's just say, it was crazy amount of realization for me as well as a trader to know my risks before jumping onto a trade, guys. I can't stress enough. Once again, I simply cannot stress enough. You have to know your risk. You have to understand that your equity is going to take a 30% hit if things go down south in any particular trade. Everything has to be systematic. Everything will be systematic. First, you understand the stop losses. First, you understand invalidations. Then you understand margin management as a whole. And then you get into the risk to reward ratios when you are actually executing in the market, right? So when you execute in the market, if you know your risk, if you have accepted the fact that maybe I could lose out on 5% of my entire equity, or even if I'm leveraged out by 2x in the market, I'm going to be losing out on 10% of my entire equity if this goes down south. This is something which I have to accept way before I think about executing a trade, guys. It's that simple. So knowing and accepting and understanding the downside before looking forward to the upside is also one of those things which you have to keep in your mind. Okay, all right. If you found out value from this video, guys, hit that like bell, subscribe if you have not done that already. That's going to help me a lot as well to grow this channel as a whole. And yes, this series will follow up with crazy amount of videos coming down the line, guys. So I'm going to be catching all of you pretty soon. Until then, happy trading, manage your risk, and have a systematic approach to the market. Bye for now.